Well, April did see something of a rebound in small caps. Some further pressure, though, coming through May. What are we seeing locally, though, now? Martin Hickson is portfolio manager at 1851 Capital and one of the underlying fund managers at Third Link, 1851 Capital, running the Capital Emerging Companies Fund. He's joining us now. Martin, good to see you.
Thanks for having me.
All right. We're actually going to talk about AI-related stocks as well, but overall, what are you seeing in small caps at the moment?
Yeah, it's actually been a very volatile period for small caps so far this calendar year. They've underperformed their large cap peers by about 8% so far this calendar year. And that's largely on the back of rising interest rates. We've seen 3 rate hikes already this calendar year, with the expectation of 1 further rate hike coming. And so unfortunately for small caps, they're quite sensitive to rising interest rates. There's a larger percentage of consumer discretionary stocks in the small cap index, a lot of REIT companies, and both those two particular sectors perform poorly when rates are rising. So we have seen a fair amount of volatility across small caps, but we're hopeful that by the end of this calendar year, we'll start to see some green shoots and some of that underperformance start to be clawed back.
Now, as we all know, that AI trade has pushed Wall Street to record after record. We've got a very small tech sector here. Nonetheless, we do get exposure there, I guess most prominently through data centers. But what stocks are you focused on potentially where you can ride that AI trade locally?
Yeah, I mean, the great thing about small caps is irrespective of what's happening in the overall macro economy, there's always particular stocks and sectors that are doing well. And one of those at the moment is the data center and that AI thematic. As you mentioned, there's not a lot of pure play ways to play that thematic here in Australia, but some of the electrical contractors have done very, very well over the last few years on the back of that rising AI and data center rollout. So in our portfolio, one particular stock that we have is SKS. It's been the best performing stock in our fund over the 6.5 years that we've been running. We were fortunate to buy shares in SKS 2 years ago, just under 40 cents. They traded around $8.50 today. So they're going up on the back of that AI thematic. They've got $1 billion pipeline worth of data center work, and that's up 5-fold from 2 years ago. So a great company, great management team. Another particular company that we own is Southern Cross Electrical. They've got a data center pipeline that's more than $1 billion. So again, benefiting from that data center rollout here in Australia.
Is that where you want to be, the build out, those servicing data centers rather than those that are actually operating it? Because it appears that it's becoming a very crowded space.
Yeah, we think so. I mean, it's the pick and shovels approach really. And these two particular companies have got great pipelines. They're less capital intensive. So a data center is very, very expensive to build. It's roughly $10 to $12 million per megawatt. These days we're seeing data center sizes around 500 megawatts. So they're very, very expensive, very capital intensive. And we have seen some of those data center operators on the ASX, NextDC as an example, Megaport at the moment, that have launched large capital raisings to fund that AI and data center rollout.
All right. Beyond that, also IPG, is that one you're looking at?
Yeah, IPG is another stock that we own in the portfolio. They're a distribution business, so distributing electrical products. So I think switchboards, buzz bars, electrical cabling. 25% of their revenue comes from the data center space. That's been a big tailwind for that particular company. So that is another one that we own currently.
All right, that one always trips me up. It's IPD, ticker code is IPG. Martin, where else are you looking at the moment? Particularly, I guess, SaaS stocks. Now, we know what's happened to them over the course of the so-called SaaS apocalypse. Are we seeing a turnaround there, do you think?
We are, particularly in the US, we're seeing a lot of those SaaS stocks that are bouncing off their lows. One company that we own that has been hit by that SaaS apocalypse in recent months has been Iris. So a software business that provides software for the funds management and the financial planning industries. The share price there has fallen by about 30%. They've got a new CEO that's joined the business in the last 12 months, Andrew Russell, ex-Bravura. We think there's a significant cost out opportunity at Iris. So the ability for him to cut costs and drive their earnings through cost cutting. Trades on a P of around 15 times, so it has derated very significantly. So that's one particular stock that has started to bounce more recently as we've seen some of those software names start to recover.
I see also that Smart Group is on your list. What are you liking about it at the moment?
Yeah, so I mean, Smart Group is one that we own. COG's another one, COG Financial. Both of those two particular businesses operate in the novated leasing space. And so both those two companies are benefiting from the strong levels of EV, electronic vehicle sales at the moment. We've seen the war in Iran that's led to higher fuel prices and consumers now buying a lot more EVs. So last calendar year, around 10% of all cars sold in Australia were electronic vehicles. If you look at the recent data, it's up around 30%. And all EVs that are sold, more than 50% of them end up on a novated lease. So that's benefiting the volumes for both Smart Group and Cog Financial.
You mentioned consumers. Obviously, they're under pressure, potentially more pain to come, particularly as far as where inflation is heading and the response from the central bank. Are those consumer-orientated stocks? Are you avoiding them at the moment? What's your positioning?
Yeah, we are avoiding them. So we've got record low levels of exposure to consumer discretionary and retail stocks. We've seen a number of earnings downgrades already in recent months in that consumer space. So profit downgrades by Accent Group, JB Hi-Fi, Super Retail, Peter Warren more recently. So it's very clear that the economy has started to slow quite significantly in recent months. That's back on the back of higher fuel prices, which we touched on, the rising interest rate environment, and then more recently the budget that's been announced. So talking to both unlisted and listed companies, they are telling us that they have seen a slowdown in the last 2 months.
Now, Martin, as I mentioned there at the top, you're one of the underlying managers for ThirdLink, which is that philanthropic fund of funds that donates to charitable initiatives and so on. What's this performance been, and how have you structured that fund?
Yeah, so ThirdLink, they're a fund of funds. So the way that their model works is that they invest in 12 Australian fund managers, and we are one of those fund managers that give them a small cap exposure. So it's a philanthropic fund, as you mentioned. So we rebate 100% of our fees. So typically at 1851, we would charge a 1.25% management fee and a 20% performance fee. We don't charge that to ThirdLink. We rebate 100% of those fees back to ThirdLink. And then what they do is that they charge their investors a 1% fee per annum. And rather than hang on to that fee, they pass it on to charities. So they've been running for around 18 years, and over that time they've donated around $25 million to Australian charities. There's a list of around 29 charities that they've supported over that period. So it's a great product for investors in that fund. They're getting strong returns. Over the last 18 years, if you had invested $100,000 at the start of that fund, it would be worth $380,000 today. And in addition to that, $40,000 would have been donated to these 29 charities. So it's a great product. It fills two purposes of providing investors a financial return, but also supporting a lot of these charities that are reliant on that funding.